just like to say a very, very big welcome to you all, and a big thank you to Peter Pfeiffer from Barclays, who has joined us today. We've got quite a lot to talk about today, so I'm not going to use an awful lot of time. But what I would like to do is just start with the poll that everybody was kind enough to answer on the way in. And can we have the results of the poll, please? Brilliant. So the biggest threat to our business, 50% of us think it's a second wave of COVID. Perhaps unsurprisingly, it's definitely taking an awful lot of the attention. And no deal Brexit weighing in at 37%. Interestingly, across our client base, more than 50% of people did say that a no deal Brexit was of greater impact to them. But once again, both are very, very big threats, so well worth us talking about. So let's move on with the slides and presentation. Brilliant. Okay, so where are we now? Well, the UK officially left the European Union with effect from the end of January this year. We had a transition deal in place until the end of December this year. And we've gone one slide too quick. Let's come back to that. I think there's a slight delay on that, but and that only means that we have 73 days with which to make sure that we're able to operate effectively with effect from January next year. Now, the big change here for everybody, and I'm just wondering why the slides aren't moving on. Okay, bear with me just a moment. Okay, so the slides are working again. Right, so but the key for everybody on this webinar is that from the 1st of January next year, all businesses will need to trade under entirely new conditions. The UK will formally not be a part of the European Union, and all goods moving across from the UK into the European Union and vice versa will be imports and exports. That means that customs declarations will definitely be required, and that customs duties can also apply. And Håkan, my colleague, is going to talk a little bit more about that in a short time. Good news is that all import VAT will be able to be accounted for on the VAT return, called deferred accounting. This means that instead of paying the VAT at the point of entry, you'll be able to make a declaration on your VAT return. Now, that's an optional arrangement. If you want to pay the VAT at the point of entry, you can. You will need to do it through either your deferment account or through a freight forwarder's deferment account, but you can do so and claim it back in the normal way if that suits you, unless if you are going to use the delayed customs declaration procedures that are in place, then you can then you will definitely have to do it on the VAT return. Otherwise, it's optional. I can't see many businesses not doing it on the VAT return because that does have a positive cash flow impact, but it's important to know that you don't necessarily have to. The free trade agreement, the government's managed to do it to me again, in that when I drafted the slides, we'd withdrawn from the talks entirely, but there was an announcement last night from the government that actually we will enter into those talks, and the talks are ongoing. This means that there is still a chance of a free trade agreement. We assess it to be about a 5-to-1 shot, or a 20% chance of a free trade agreement being made. A lot of people are saying there's no chance at all of a comprehensive free trade agreement. My only observation there is that in many ways it's quicker and easier to agree a comprehensive free trade agreement, as in everything is free trade, than a minor one. So these different categories. So it'd be interesting to see what transpires over the next few months. But I can't emphasize this enough. The procedures will still change. You will still need to do customs declarations even under a free trade agreement. So what does that mean to us? So I'm going to talk a little bit about VAT, and I'm going to talk first about the arrangements for business-to-business transactions across the European Union. And there are two ways that this operates. So firstly, Goods coming into the UK that are imported and then sold will mean that if they are imported by the supplier, the overseas supplier, that supplier will have to register for VAT in the UK and account for VAT on the onward sale. Transversely, if you are sending goods from the UK into the European Union and then selling those goods, and you are the importer into the European Union, you will have to account for VAT on the sale, and you will need to register for VAT overseas. The key points here are that most European member states have either got a zero limit for non-EU established business or a very, very low one. So even very small amounts of trade might render you liable if you are the importer of record. Now, the key difference here is in the contract, and we'll talk about that in a second, and in your Incoterms. So you need to have a very, very careful look to see that whether you are going to be responsible for bringing goods into the European Union and then paying for the customs duties and and making the declaration as importer, and then selling them, because that will give you an obligation to register for VAT. Some more registration issues, and I know I've talked about these before, so I'm going to go over these with quite a light touch. The EU rules have a whole series of simplifications appended to them. And most of these are designed to stop businesses in one member state having to register for VAT in multiple member states. When the UK leaves the European Union, effective from 73 days' time, these simplifications will simply fall away. So we'll no longer be able to look at using call-off stock or supply and install. So call-off stock applies by allowing a business to hold stock which is drawn down by their customer without being required to register in that member state. Now, if you hold stock overseas which is drawn down and sold while it's overseas, you will need to register for VAT there. Likewise with supply and install. So if you are taking goods from the UK and installing it into a client site, that's likely to give you a requirement to register for VAT. There may be some other reliefs, but that's your starting point. Thirdly, and this is where the diagram comes in, triangulation falls away. Triangulation is a wonderful thing for all VAT graduates, and that talks about where you buy, and it's very, very simple. Basically, where you buy goods in one member state and have them delivered to a second member state. So if you, from the UK, buy goods in France, and those goods are delivered to your customer in Germany, you will now have an obligation to register for VAT in Germany. Or alternatively in France, where you can buy the goods locally and then make an inter-community movement. But the important thing is that if you do that now, it's going to trigger that liability. If you don't do so, then the manufacturer, in this example, will charge you local VAT and you won't be able to recover it. So where does that leave us? Basically, import, local sale, lead to registration. What does that mean? So what I would urge everybody to do is look at your B2B supply chains and consider whether you've got a VAT registration requirement. That is likely to be driven by who is going to be importing the goods, either into the UK or in another EU member state. And that in itself is driven by the Incoterms and the contractual arrangements that you have. So what you need to do is you need to look at your customers' contracts and see whether your customer is going to import those goods into an EU member state, or whether you are going to be obliged to import them and then sell them locally. So the Incoterms you're using, I've used the old ones for ease of reference, but there are many, many, many Incoterms. There are websites available from Google that will enable you to work out which is the correct Incoterm to use, and I'm sure that Håkan will mention it in a minute. But if you're looking at delivered duty paid or fully delivered, that suggests that you are the importer. So if you're selling goods DDP from the UK into France, you will be obliged to do the import declaration into France, and you will be registrable for VAT in France. Likewise, the Incoterms Ex Works or cost insurance freight, actually DCIF, not CIS, my apologies, that suggests that your customer will be importing. So you'll be making a sale from the UK that they will be importing locally, and that means that you won't have to register for VAT. So that's all very good for B2B. What we've talked about less on these webinars is B2C. So retailers, particularly online retailers. So the position at the moment for an online retailer going B2C from the UK to the customer's member state is that VAT is accounted for in the UK as a starting point. So if you sell goods to a French person in a private individual, you will charge them UK VAT until you reach a threshold set by each member state, and they have a choice of either 35,000 euro or 100,000 euro for their limit. But once you reach that limit, you're then obliged to register for VAT locally and account for local VAT on those supplies. For many businesses, that means that you don't need to register overseas for your online retail business, and that you can continue along the way. Obviously, there's no customs duties or import VAT because the goods are deemed to be inter-community movements. So with effect from January, this position changes. And unfortunately, it's going to be slightly more complicated because the position will change again in either July or a later date if the Germans have their way. And I'll explain briefly what that's about. So the European Union saw this coming, and they introduced a situation where an online retailer from outside the European Union, where that person sold goods to individuals, they would be obliged to register within the European Union, but they would only have to do so once. A so-called import one-stop shop. Okay, and there's an awful lot of one-stop shops. There's about 4 of them actually. It gets a little bit complicated, but what this basically meant that if you sold goods from outside the European Union to private individuals within the European Union, that you could account for VAT at the local rate on that sale. So if you had a French person, obviously that would be a French VAT. If you had a German person, it would be German VAT, Polish person, Polish VAT, etc. But you would only have to do one VAT return covering everything. Unfortunately, because of COVID, the European Union has postponed the implementation of that one-stop shop. So the one-stop shop will only be available from July this year. And actually, the Germans, I understand, have applied to have that extended even further. So you're at least 6 months under basic rules and possibly further. So between January and July, what will happen if you sell goods to an individual in another EU member state is that they will be the importer of record, and they will be obliged to account for VAT and customs duty on those. Now, obviously, from a customer consideration and customer experience, that's not great. So if your French customer has to go down to the local customs house and pay the VAT and the duty and an admin charge to release their goods, they're not going to be very happy with you. So many businesses are looking at ways around that. There is a thing called the low value consignment relief, which means that goods less than 22 euro, I believe it is, should be free of VAT, but it's not evenly applied across the European Union. Not all member states use it, and actually you will find that even if you do seek to use it, you're going to have a problem with that. So what are we going to do if you make that problem go away? Well, the answer is that you can, if you wish to, import the goods into a central point in Europe and then sell them onwards. So if you're the importer of record, at a starting point, that means that you're going to be importing goods into a local country and you're going to be selling goods in that country, which means you are going to be obliged to register for VAT wherever you make a sale. You can get around that by having a single registration and bringing everything through that, so importing everything into the Netherlands, for example, and then selling it onwards. But you do need to put that in place, and you do need to be wary of the local rules. So where we've implemented that, we've done so with our colleagues in BDO, the Netherlands, to make sure that we're not compromising any of the rules locally. So appears to be the same slide again, but I think that should be post July 2021. I'll adjust these slides and resend them out. So after July, there'll be that one-stop shop will be available, provided the goods are under a value of 150 euro. you'll be able to have a single VAT registration and account for VAT in all the different EU member states. That means that you'll only have one VAT return and it will have 27 boxes in it, and you'll be able to account for local VAT. As I say, the Germans have applied to have that date put back, and it was originally put back from January to July. It looks like it's going to go back from July, possibly even to the end of the year, but we don't know yet. We're still waiting for that to come through. So finally, I want to quickly mention services, because there is an assumption that services are not really impacted. And to a large degree, that's true. It's a much lower impact on them than goods, but it's still important to understand where some of the boundaries are. So most supplies, business to business, will remain exactly the same. So if you're selling services to a French customer, the only real difference is accounting differences, yeah? So you won't have to put their VAT registration number on it, although it'd be good practice too, because it shows that they're in business. And that's it, really. That should remain the same. Some B2C supplies, so supplies of traditional consulting, so accountancy, consulting arrangements to private individuals, will become VAT-free because there's no taxing mechanism for them, but they're quite limited and they don't cover things where there is a use and enjoyment provision. Use and enjoyment provisions will have more impact than that post-Brexit, obviously, because they'll be supplied by somebody who's not within the European Union. So each member state has an option over various different things to say that actually, if you supply these in a way that ends up without taxation, we can look at where the supply takes place. And where you're looking at use enjoyment provisions, you're looking at advertising, particularly in Spain, telecom services in all member states, and electronic supply services, which particularly B2C will give rise to a registration under the non-EU mini one-stop shop. As I said, there's quite a few of these. What will change, of course, is financial services. The specified services order in the UK basically says that any non-EU intermediary or shared transactions will give rise to a right to recover VAT in the UK, providing that the transaction takes place outside the European Union. That will now be anywhere outside the UK, so VAT recovery will increase slightly. Unfortunately, on the tour operators margin scheme, there is still an awful lot of confusion around, and the revenue are still, I believe, sitting down with ABTA trying to work out exactly what that's going to look like. So I'm unable to tell you exactly how that is. So I think everyone's had enough of me now, talking away. And so I'm going to hand over to Håkan, who's going to talk a little bit about the customs considerations on e-commerce and B2B. Håkan.
Thank you very much, Glenn. Let's see if I can take control of that presentation here. And I think I have it. Yeah, excellent. Good. So I will talk about customs aspects. To some extent, they will mirror what Glenn has gone through here. As Glenn said, things to keep in mind that will be important are what Incoterms you are using with your customers and suppliers. I seem to have the same problem as Glenn with the slide jumping one ahead. On the customer side, of course, we talk only about goods movements. We're not talking about services. And in the slides I'm going through here now, I'm talking both about B2B and B2C. There will be different, of course, concerns with the two, but fundamentally, they will work the same. So as I'm trying to get back control of the slides, I can go back to the previous slide, but doesn't seem to work.
Okay, I'll see if I can take control of the slides and do them for you. you might need to give me a little bit of a prod. So I'm going to see if I can take control of the slides and take that irritation away from you. Bear with me.
Great, thank you. So I first want to talk about when you are exporting out of the UK. And of course, we'll focus on when you're exporting to EU customers, because that's of course what will change. There we go. So we got the right slide. Excellent. So when you are exporting, as Glenn said, there will be customs declarations required. So first of all, there will be an export declaration required from the UK. So as the situation here that I've depicted, we imagine that you are then the exporter, and you could of course be the importer in the EU too, but the normal situation is that your customer is going to be the importer into the EU. So in the normal situation, there will be an additional admin burden, and there will be costs associated, of course, to the making of those declarations, whether you make the declarations yourself or if you're using an agent to make the declarations on your behalf. But especially with the B2C, as Glenn already talked about, it is not ideal to have your EU customer being the importer. And there could be situations where your EU customer simply can't be the importer. So for various reasons, you might be forced to take on the role as importer in the EU to keep that customer. So what will you then need to do? Here's that very tricky situation, because you as a UK company, you're no longer established in the EU after 1st of January. And to be able to make a declaration in the EU, an import declaration, the EU customs law is very clear. You need to be established. So that is something to consider. I would advise you, we'll have later, Glenn will come back to a summary of what we think that you ought to be doing right now. But one of the things is clearly to talk to your EU customers about who should be importer into the EU. And I think in this context, I won't go into too much detail, but I think the next slide is really important because it talks about the requirements to be able to be an importer into the EU. Let me see if I can move down to the next slide. I can't. So Glenn, I hope that you can move it for us. Perfect. Now this is a bit technical, but I think this session is a bit more technical than the sessions we've done before. So I think that is justified. The interesting thing to note and remember is that the definitions in the customs law is not necessarily the same definitions as in the VAT law or corporate tax law. And especially when it comes to the established in the EU definition, you have some nuances there. So on the screen, as you see, if you want to be importer in the EU, you need to have the necessary human and technical resources. That's really a key thing. Does that mean that you need to have people on the ground? Do you need to have bank account? Do you need to have someone present in the office in the EU full-time or office hours? So all of those considerations is really important because, of course, if you do set up an establishment in the EU, it's not only a customs consequence of that, there's also VAT and corporate tax consequences, employment tax, etc. So this piece about how to get the goods into the EU to your customer is just one small piece of a much bigger puzzle. So as Glenn said, we work together closely with our colleagues in BDO Germany, BDO Netherlands, BDO Ireland, etc., both on the custom side and the VAT side, and where required on the corporate tax side. So I've made a little note there too about that. Not all member states apply they apply the definition, but they interpret what is the necessary human and technical resources. What exactly does that mean? So that's also worth keeping in mind, that you may need to, through us, get advice from the local firms in more than one country. So that's all really I was planning to say about export. We will have a Q&A session at the end, so we can talk about this in a more detail. But I wanted to move on from the export side to the import. So if you are after 1st of January bringing goods into the UK from the EU, what do you need to think of? So again, I've sketched that scenario here. The situation is that you are bringing goods in from the EU, from your supplier, and your EU supplier is saying, I will not deliver on DDP terms. You, the UK company, will have to be importing into the UK. That is a fair assumption, I think. So what do you then need to do? And as Glenn said earlier, this, of course, after 1st of January is a different situation. You can't just bring the goods in from the EU as you do today. You need to make a declaration. And taking one step back, if you think of it from your EU supplier's point of view, they will need to lodge an EU export declaration before the goods even arrive in the UK. So for you then to make a declaration, what do you need to do? Well, you can make the declaration yourself. You need to be connected to HMRC's declaration system and make the declaration. You're free to do that. In reality, most companies will use a third party, freight forwarder or other customs agent to make that declaration on your behalf. And that agent can act either as a direct or an indirect representative in EU customs terminology. That means that if they're acting as your direct representative, they will just make the declaration. They're not taking responsibility for the correctness of the declaration. If they're acting as indirect representative, they will have joint and several liability with you, the importer, for the customs debt. So those are the options really for you. You need to either be able to make the declarations yourself, or you need to have an agent to make the declarations on your behalf. So just briefly on the delayed declaration system that HMRC has announced. So this is what is referred to as the border operating model, where for the first 6 months after 1st of January, most products can be brought into the UK, I should say, brought into Great Britain from the EU. Most of those products can be brought in without actually having to make a declaration at the time that the goods come into the country. So you can delay making that declaration and also delay paying the customs duty until ultimately 1st of July or 30th of June. So you can do that. And if we can talk more about that in the Q&A session if you have specific questions about that. But I should say that if you decide to make use of that offer, you need to have your own deferment account, or you need to have access to someone else's deferment account. For example, your freight forwarder's deferment account. That is a requirement for using this delayed declaration. So of course you do need to keep track of what you bring into the country, and it is of course fraught with danger if you are bringing goods in and not keeping good track of it, because it will, as I said, eventually have to be declared, and it is your responsibility. So the duty that you're paying on the goods coming into the UK, that will be in accordance with the new UK tariff. So the UK duty rates in most cases differ slightly from the EU's current duty rates. So that's also worthwhile having a look so you're prepared. Is the duty rate for your particular products the same, or perhaps lower, or perhaps zero going forward? That will be important for you to know in advance. When you make the declaration, or if you have an agent making declaration on your behalf, you also need to know there are the key data that you need to be on top of. I mentioned the commodity code that drives the duty rate, but it's also key information such as the country of origin of the goods and the value of the goods. So that's to be considered. And I think just finishing off my part here on the customs is, what can you do to try to mitigate those additional costs that you will have in most situations? Well, there are different reliefs, and I thought I'll just mention very briefly, without getting into detail, customs warehousing and inward processing relief, because those are the two that I imagine that many UK companies will want to make use of. They work in a similar way. The difference is that customs warehouse is intended for storing goods, and inward processing is intended for goods where you do some kind of processing, some kind of value add to the goods that you bring into the UK. Just a very simple example: if you bring in goods for 100, where you have duty cost of £100,000, and after storing or processing, you are re-exporting 40% of the goods, then you have a great potential saving there. If you also re-export into the rest of the world, another 20%, then again, that's another saving. So you can potentially, if you're re-exporting 60%, whether they go to the EU or rest of the world, you have a potential 60,000 saving there in your duty cost. So it's definitely something worth looking at. If goods are coming into the UK and staying in the UK, you will have to pay the full £100,000 duty. You would pay it later, but you would pay it nevertheless. But if you are bringing goods into the country and you are not sure at that point whether the goods will actually stay in the UK or if they later will be re-exported, then you can use these reliefs, and it's definitely worthwhile looking into them. So I think with that, I'll hand back to Glenn just to summarize from both that and customs point of view, what we think that you should be doing right now.
A couple of very, very quick apologies from me to say sorry that the slides got muddled there, and my apologies to Håkan. I kept thinking he was going to move on to the next slide and didn't. So my apologies for that. So what do we do now? Well, it goes without saying to make sure that you have a UK EORI number. Otherwise, your goods are not going to come into the UK, and that really is going to be fundamental. I'm guessing that most people either have one because they've applied for it themselves, or the revenue automatically gave it to them as it did at the end of the last set of negotiations. Do map your supply chains and your distribution channels and put in your Incoterms. Your key question: who is importing, who is exporting, who is going to do that, and how are you going to do that? Check that your shippers need to know what they're doing for the 1st of January. There's some great comments on the chat from Mike McCormack, Mark McCormack, basically about the deferred declaration system, and they seem perfectly correct to me, although Håkan might want to make some comments in a moment. But yeah, make sure that you know where you are. Make sure your customers know where you are. If you believe that your customer is going to be the importer, make sure they know it, basically, so they're not going to get a shock and cause you some problems. How are you going to do your import and export declarations? You know, you're probably going to need a third party, but if you're going to do it yourself, then it's important to know how you're going to do that and whose responsibility is that. Håkan, do you want to take the rest? Ah.
Oh, sorry. Okay, I'm unmuted. Sorry, Glenn, where did you leave off exactly?
So, we were saying that we investigate the UK deferred declaration option available for the first 6 months. I don't know if you want to say anything about that.
Yeah, there is a list of goods that are controlled in this sense. So you could not use that deferred declaration or delayed declaration for them. So that's important to have a look at first. Can you even use it? If your goods are listed on that controlled goods list, then you will not be able to use it. Also, if you have a poor compliance record, HMRC will not allow you to use it either. But for most companies, you will be able to use this. And as I said earlier, you just need to make sure that you have access to a deferment account. That's really a discussion you need to have with your freight forwarder. If you don't have your own deferment account, can you use theirs? And normally they will say yes against a fee.
Deferment account in that case is for the customs duties element. The VAT element will go on the VAT return. So all deferred, wherever you use a deferred declaration system, you're going to have to account for the VAT on your VAT return. You're not going to be able to do that on your through your deferment account. That's quite important. We've had a comment, Håkan, that you need to be approved for CFSP as an importer to use deferred accounting. Is that? I mean, presumably, I don't know that's the case, but do you want to say a few words about that?
Yeah, again, it's the same principle as with the deferment account. Either you need to have CFSP, which stands for Customs Freight Simplified Procedure. There's an authorization from HMRC. You need to either have that yourself, or you can use someone else's CFSP in the same way that you can use someone else's deferment account. So again, most freight forwarders will be able to offer that. Traditionally, freight forwarders have not been keen to offer that, because if something goes wrong, then their authorization is at risk of being suspended or withdrawn by HMRC. But HMRC has hinted in public informal communication on gov.uk that they may not hold the freight forwarder, the agent, responsible in that way if something goes wrong. And I imagine that they do that because they know otherwise freight forwarders are going to be unwilling to let importers use their CFSP.
Okay. Final point. Have a think about AEO. Obviously, you can't get that for January unless you're quite a long way down the process, because it takes a few months to put in place. But would it be worthwhile doing that going forward in the short to medium term? You need to upskill your accountant, your staff through customs training. Obviously, there is a customs training grant that's available for all UK businesses that might have to do VAT customs declarations. So that's fully funded training. If you need to know anything about that, do let us know and we can send you a flyer on that. Final word from me, really, don't forget the mundane. Okay, the VAT accounting, export evidence, and Intrastat are still all required. Intrastat, we all thought we'd lost. You're still going to have to do Intrastat for arrivals. But your VAT accounting will change, and it's important that you just get yourself geared up for that. It's not going to be massive changes, but obviously many of you will be operating ERP systems that might need changes, and you're all going to be subject to making tax digital for VAT. So it's important to have a look at those small changes, make sure they're reflected. Peter, I'm very, very sorry that we've run on. Shall I hand over to you now?
Yeah, thank you very much, Glyn. And thanks, Håkan, as well. That was really informative and a detailed analysis of customs and tax considerations post-Brexit. And I'm conscious that we've had a few technical issues and there's lots of questions queuing up for Glyn and Håkan. So I'll try and be concise in my section. So my name is Peter Pfeiffer, and I'm a trade director at Barclays, working in the trade and working capital team. I advise businesses across the Thames Valley who trade internationally how to mitigate risk for non-payment of goods shipped. I also help release cash from cross-border or domestic trade transactions, which would otherwise be tied up in invoices or purchase orders for extended periods. I'm just going to see if I can move the slide along. No, it doesn't seem to be working for me, I'm sorry. I don't know whether someone can help me to move the slide along. That would be great. But basically, in this part of today's presentation, I'm going to be talking through the following three areas. Firstly, how Barclays is supporting international traders. Secondly, key considerations as we plan for the new world after leaving the EU. And finally, the importance of reviewing your trade cycle. If we could go on to the third slide, that would be great. Thank you. Right, so this slide is a little bit of a recap for some of you who joined our webinar back in July. And so I'm just going to briefly summarize our approach to supporting international trade. So Barclays are passionate about supporting clients who trade internationally. And there are both challenges and opportunities in this current economic climate. And our role is very much to support our clients through that journey as a trusted trade advisor. Our role is to understand your business cycle and to provide you with a bespoke support, risk mitigation, and funding solutions where appropriate. We're working closely with a number of key organizations such as BDO, the Department of International Trade, HMRC, UK Export Finance, and Chambers of Commerce. This collaborative approach ensures clients have access to the support and best advice they need to succeed. Moving on to the next slide. Thank you. So basically, we're regularly speaking to clients about their Brexit preparations, and now COVID has obviously become very important as well. So on this slide, it really sort of covers a lot of areas that are coming up in our conversations with clients. A lot of them have already been covered by Glyn and Håkan, so I'm really just going to try and focus on the key financial implications that may impact your working capital and your ability to trade overseas. So as has been highlighted earlier, we are seeing wholesale changes to compliance, customs, tax and tariffs. And businesses obviously need to be aware of the implications of these changes and ensure they stay up to date with any developments, as there is a high probability that this won't be the final version before the year end. Some key questions to be asking yourselves are as follows. Are your staff ready for changes, or do they need customs and export training? Have you checked whether you're eligible for HMRC grants to help support the upskilling costs? Many of our clients have benefited from BDO's customs training and saved thousands of pounds by accessing HMRC grants. And that's something that Håkan has been running really well for us. And I know one of our clients saved something in the region of £20,000 in training fees. So it's definitely something that's worth investigating. Have you held discussions with your buyers and suppliers to ensure both sides are ready for the changes? In addition, have you considered the terms of trade, also known as Incoterms? Incoterms have been covered today, and I just want to really emphasize the importance of making sure that you understand who is responsible for the costs involved in the delivery of goods. And such costs include insurance, freight, shipping, and duty. Incoterms also determine who's responsible for the import and export declarations. We're noticing at the moment that many of our overseas suppliers are now asking for payment in advance. Does your cash flow allow for advance payments? And what guarantees do you have that goods will be received? If you're selling overseas, do you require payment in advance? And is your overseas buyer asking for guaranteed delivery? Letters of credit can help provide guarantees, at the same time enabling you to make or receive payments in advance to help your cash flow. Have you considered how cash flow could be affected due to additional stock holding, or if you see adverse changes to creditor or debtor terms? And have you discussed your working capital requirements with your bank? Lastly, with the US elections in November and Brexit negotiations intensifying during the coming weeks, we expect increased foreign exchange volatility, which should also be taken into account with your Brexit planning. Many of the Barclays clients on the call will be familiar with Billy Wells, who's our foreign exchange expert. And Billy would be happy to speak to any of you about your concerns and how to manage your foreign exchange exposure in the coming months. So moving on to the next slide. And the final slide, you'll be glad to know. So this is one of our key areas of support from Barclays Trade and Working Capital. And it's a detailed analysis of your trade cycle. So this covers the business cycle from procurement of goods through to the completion of the sale. The benefits of reviewing your trade cycle include performing a risk review over both buyers and suppliers, understanding where allocation of capital and resource is best employed, whether your terms of trade are appropriate and reflective of risk, ensuring working capital is managed efficiently and your bank facilities are sufficient for 2021 and beyond. The earlier you engage your advisors for support, the better. New bank facilities, for example, can take several weeks, not days, to implement. I appreciate there's been a lot of information to digest today, and so I recommend staying close to developments during the coming weeks and maintaining regular dialogue with BDO and your advisors, your bankers, freight forwarders, suppliers and buyers to make sure that you're aware of any blind spots that may cause delays and extra cost. Please feel free to contact me if you'd like to discuss how Barclays can support with an in-depth review of your trade cycle and Brexit planning. This concludes this part of the session, and I'd like to thank BDO for inviting me along today. And I'm going to hand back to Glyn to provide his closing thoughts and open up to Q&A.
Really grateful to have you alongside us, and my apologies again for the technical hitches at the beginning of the presentations, but these things are always stressful, even when we've done them a few times. So the point that I take from Peter's presentation, really, I think I take two things really, is there are a lot of things to consider here, and time is of the essence. If you need stuff from the bank, or you need stuff from your advisors, or you need stuff from freight forwarders, obviously time is running a little bit short, and these things do take time. We've got Christmas coming up as well, which will be another delay, and COVID hasn't helped anybody with their responsiveness. So I would really echo that, and I think it's really interesting how those sort of tie together. So finally, we're going to open up to some questions now. I'm probably in view of the time, I'm going to probably quote them and ask individual panelists to jump in. So we've had some questions. So the first one is, how are you required to track goods in and out under the inward processing relief, just by volume or by serial number? One for Håkan, I think.
Yeah, absolutely. Great question. So inward processing relief, it requires that you keep track of what is coming into the country, and then you need to make a declaration about have they left the country or are they still in the country. So depends on what product it is that you are processing. But say if you're importing something in bulk. So say, for example, raw material. I don't know, we can mention rubber. If you import rubber and you import 10 tons, then you need to keep track of, has 5 tons left the country, or was it 3 tons, etc. And you need to be able to go back and show in your accounting system, your ERP system, when the goods arrived and when they left. But no, most of the time you do not need to account for the serial numbers. So the goods can substitute for each other.
Brilliant. Okay. I'm going to take one question from the chat, actually, because I think it was an absolutely perfect point to make. From Jennifer saying the import VAT settled on the VAT return, basically in order to have that formally part of the deferred accounting system, there's a tick box on the form that the carriers do, and it's possible that they will get that wrong, particularly in the early days. So I think what Jennifer's tax department has suggested is that they increase their deferment facility to make sure that they don't go over that for the increased VAT amounts. I think that's a sensible thing. You know, in the early days of the operation of both deferred VAT accounting the customs simplified arrangements, it's almost certainly going to have some difficulties. So yeah, I mean, anything that creates another safety net is a good idea. So I think that's great. So thank you for raising that. What I would say is that I would monitor it, because it shouldn't be necessary, and one would hope that in due course that the freight forwarders will end up in a position where they are defaulting to saying that the deferred accounting will apply, and therefore you may find it falls away, the requirement, because obviously, you know, you need a bank guarantee and there's a cost to that. So I think that's really helpful. So looking at the questions we've had in Q&A, is any action required to apply for the postponed VAT accounting in the UK, or will it apply automatically? Our understanding at the moment is that it's going to apply automatically. Certainly that's what's in everything that's been put out there, but we will keep an eye on that and hopefully tell people if that's not the case. So yes, should apply automatically, no action required to apply for it. We had another question in the chat, or a comment in the chat, saying that there are courier companies putting in place arrangements where you can be the importer and they'll arrange for all the VAT and the customs duties to be paid. Yep, there are a number of them, and I've seen some of them. Hopefully they will work well and provide a solution, particularly if it's only required for 6 months. My observation will be, if it goes over 6 months, obviously that's going to become quite expensive and quite a difficult thing for people to do. So I would watch that as we go forward. So final question, I think. Will a warehouse in the Netherlands meet the criteria of permanence to allow a UK seller to import into the Netherlands as importer of record? My understanding from my Dutch colleagues is yes, it will. Particularly if you have a warehouse there, but I would take each case on its own merits, and where we're going to be relying on importing something into a country, I think my advice would be to make sure that we've got some specific advice that covers that. This is obviously quite a nuanced and quickly changing scenario, so we really need to address these things as we come forward. And I think I'm running out of time here, really, but I know we've had quite a few questions beforehand. If we haven't got to your questions, don't worry. We will send the answers to all of the questions around to everybody as far as we can. And if you have any questions that we've not covered, please feel free to reach out to any of the panelists, and they'll be more than happy to deal with those for you. I think my contact details are in the slides. So it remains for me really to say thank you very much for your patience. Thank you very much for putting up with our technical glitches. I hope this was really useful to you. I know I found Peter's session very interesting. So I hope that you found our sessions equally as interesting. And I look forward to speaking to you all in the future. Thank you all.